Good morning. People are still arriving, but I think we should probably get going. Fair bit to get through this week. So I've got a couple of news, actually not that much, but Andrew's obviously going to talk about what happened over the course of July. And then our guest this week is Fotis Hajimilakis of Impacts Environmental Markets, not markets. I get something wrong. And he'll be talking to us, obviously, telling us how that one's going later on. But first, bits of news. There are lots of sort of things going on this week, but the two things I pulled out, ThomasLloyd Energy Impact and BioPharma Credit. ThomasLloyd, obviously, we've been talking about for a while now. So the requisition was on the 11th of July. We didn't know who the requisitionists were until recently, but they were two of the funds that the manager runs. And they called a meeting to force a continuation vote, presumably because they think that it's going to sell through it and then they'll be able to carry on going. But on the 31st of July this week, the board set out its case for why it thinks shareholders should vote against continuation. And it's pretty detailed and pretty convincing, I think. So we're kind of siding with the board on this one. So amongst the things that the board are unhappy with is that there are still like to be quite a delay to finalising the valuation at the end of December 22. And without that, they can't finish the accounts. And without that, they can't lift the suspension of trading. So that's stuck for a while longer yet. It still doesn't know why it wasn't told what was going wrong with the project in India, the RUMS project, until the 17th of April 2023. So if you remember, this is a solar project where the costs suddenly ballooned and it made the whole thing completely unviable. And if they pull out, there are liabilities for that project that they were told were originally were $5 million, but now look more like they're going to be $33 million. So that's obviously quite serious. And they're saying too that in the process of trying to put together the end of year accounts, the auditor wasn't told that there was another project that had been agreed to do on the 5th of December. That's just weird. I mean, I can't understand why you wouldn't have told the auditor that, but there we go. Well, it's all the information. So they might have been told that on the sort of headline level it happened, but not the information they needed to value it. Then the manager's sort of doing its own investigation into what went wrong, but it's being weirdly secretive about it. So it's told the board that the board can't know what the investigation is looking into, or won't get a full report. And neither will the auditor even get the full report. The manager will let the auditor see a summary of what happened, but on condition it doesn't pass this to the board, which is just strange again. It's almost like the manager's trying to protect himself from being sued or something. So the board put a whole long list of questions to the manager on the 19th of June when all of this sort of blew up, and it says it still hasn't got answers to those, which is obviously, really not on. And it's also questioning whether this internal investigation that's going on there, whether it's really independent or not, because they're sort of implying that some of these sort of witnesses might be lent on a bit. So we just don't know how far the end December NAV is going to fall. There's been more things uncovered other than just this problem with solar arise. So on a kind of macro level, for example, they say that the Philippines power prices that have been used to value this Philippine solar projects were being overestimated, and they've got an independent consultant to come in and relook at those, and that will reduce the value of those projects. But they're saying that their sort of general look at things has suggested that revenue assumptions, cost assumptions, tax assumptions are all unrealistically optimistic, which could suggest there's quite a big drop in the NAV to come, and that's really quite scary, I think. And I think with all of that, with all of these failings, with all of this to and froing, there's no real hope of growing the fund, which is obviously what the manager hopes to do. I managed to do a continuation vote, put this to bed, and get back to raising money. I just cannot see that happening. So there's a meeting on the 24th of August, as I say, I think presumably they call it as the manager thought it would win it. And you might worry that if it thinks it now can't win it, it will just pull requisition. But the vote will still happen because the board is going to hold the postponed bit of the AGM that didn't happen before. So there's the continuation vote at the moment. People are being asked to vote on this twice. So one sort of negates the other one. But if the requisition vote doesn't happen, then the AGM's continuation vote will still be held. And the board's pointed out that although the manager had quite a generous kind of compensation scheme if it got sacked early in the life of the fund, that doesn't apply if the continuation vote gets lost. So there's no additional cost to shareholders from that. Assuming the continuation vote doesn't go through, then the board's now then got to come up with a new plan. And it feels, and I completely agree, that the general idea of the fund was a good one. I mean, to try and provide money to encourage the rollout of renewable energy in more kind of emerging markets was a good tick in the box, something we ought to be supporting, and something that actually ought to be quite profitable in the end, but it's definitely complicated. So if they could find a new manager and shareholders could be convinced that made sense, then I definitely support that. The alternative is some kind of managed wind down. And then it's just a question of how long it's going to take to sell these things and then what price can they get for them. I think whatever happens though, if you're a shareholder in this, you're not looking at getting back what you think the current NAV is now. It's definitely going to be down below that. So there's that. BioPharma Credit, again, we've talked about this one for a couple of times before. The discounts widened out here quite a bit now, despite the fact it trades for quite an attractive yield. And it's actually done a pretty good job since it started. But I just wanted to highlight, because this came out this week, it just shows how good this fund is when it's all going well. So we reported back in May 2023 that they were going to lend some money to a firm called Reata Pharmaceuticals, which makes cures for rare genetic diseases. It's got something that works already that seems to be working. So it was 5-year money drawn down in tranches, 7.5% above the sort of benchmark rate in the US, which is obviously quite attractive. There's a 2% upfront fee that BioPharma can just bank, and then what do they call a make whole arrangement. So basically, if they repay the loan early within the first 2 years, then all of the interest that they would have earned over that period, over the remainder of that first 2-year period, they get that as a lump sum, and they also get a 3% prepayment premium on top as well, so 3% of the money coming back. So what's happened is that Biogen has bought Reata for $7 billion. Now this plays into another thing that we've been talking about before, which is that the smaller biotech stuff is undervalued, is unloved, and people are coming around with quite big checks and just saying, well, I have that, thank you very much. And it's another example of consolidation, and why I think things like institutional biotech and biotech growth are probably looking not too bad value. But the point of this, because this is a change of control, that triggers a whole repayment of the loan. So it's going to get back $15.5 million on top of plus the 62.5 million it's in it so far. You can see that's an enormous return on the amount of money just over a few months. Good stuff. Now, there is a problem here, and this is what we've talked about before, that there's still one loan in the portfolio, so quite a concentrated portfolio, that is not performing very well. And it's a UK business that makes diagnostic tests and it's been hit by COVID. We talked about it on the 19th of May, so if you want to go back and watch that, you can find out what happened there. They've been gradually pushing on this. They've now got directors on the board of it, as observers, I think, rather than as sort of full directors. Nevertheless, they've asked it for a strategic review. I think we're edging towards, unless Lumira can raise some money, we're edging towards the lenders putting the plug on the equity investors and then trying to find a buyer for the business. they're quite good at underwriting, these people. Still, I'm not sure they're going to get all of their money back. If they do that, we'll have to wait and see. The better option would be that some outside funding comes in, or they manage to sell it to somebody else beforehand. The hit is obviously potentially quite large, but it's nowhere near as big as the current discount. So I do think once this is resolved, especially if this gets resolved without any kind of loss to the fund, then that discount ought to come rattling in, and it is a great investment. Anyway, so there we go. That is enough from me. I'm going to hand over to Andrew.
Brilliant. Thank you very much, James. That's a terrific game there for BioPharma Credit. Right, so let's have a look at the movers for July, which overall actually was quite a reasonable month. I think the investment trust index was up a couple of percentage points, more or less regaining the amount it lost in June. Anyway, at the top of the list of risers, by quite some margin, is Seraphim Space, which I did talk about last month. My sense with that one was really that there was nothing wrong with the trust, but just no one wanted to buy it. No one was brave enough. And I don't think it takes very much in the way of buying interest to move some of these really bombed out growth capital names where the liquidity is reasonably limited. And I think we've seen that here. It's recovered a long way, but it is still on a discount of nearly 53%. So it's only a partial recovery, that's for sure. And I think it has been helped as well by the trust buying back shares. And we have seen, obviously, trusts in the alternative asset sector starting to buy back shares where previously this hadn't happened. And clearly there are always mixed feelings about share buybacks, but I think there are at least 2 or 3 examples where it's worked very well. This potentially is one. And I think actually when HarbourVest Global Private Equity bought back quite aggressively in the market, that did shift the asset value as the share price somewhat against the asset value, although actually it's slipped back a bit since. This is relevant because actually there's more of this now going on, and Pantheon International announced a new buyback program this week that seems quite substantial and was welcomed by the market, and it does have a 40% discount to bring in. Anyway, before I digress any further, there were a couple of themes, I think, in the gainers over the month. And in part, it was driven by the big news of July, which was in the middle of the month. You'll remember the UK inflation rate came in below expectations at 7.9%. And that meant, I think, that interest rate expectations moderated somewhat. And that helped the property sector, which is clearly the most interest rate sensitive of all. So there's a fair few gains here for the property sector. A couple of them are very specific. So CT Property Trust is being taken over. Eddystone Property Investment Company, I think, is edging towards a portfolio sale. We should have news on that fairly soon. And I'll talk about Tritax Big Box REIT in a moment. And the other sector that did well, which I also spoke about last month, is emerging markets, where I think there was some good value there. And most emerging markets are not suffering greatly with the inflationary problems that some of the Western nations are. So we've seen some decent rises across China and Vietnam, and actually into Latin America as well. So a good broad-based rally there. So let's talk about Tritax Big Box. And there were 2 reasons really why I picked this out to speak about. One is that it is a very substantial trust, and so it matters and people take notice of it. And therefore, what happens here could be replicated elsewhere. And I think the second thing is that this was one of the, I think, most notable fallers when this property sector fell out of bed at the end of last year. And part of that was because it was previously, I think, the hottest subsector, these big warehouses, which obviously benefited during COVID and the increase in home deliveries of goods. But as a result, I think it also had very low yields on its portfolio. And that meant that when the yield expansion began, this one suffered more than most. But actually now everything seems to have settled down quite well. And if you look at yesterday's results, if you just ignore the context of what's happened recently, actually they look tremendously stable and solid, in my opinion. So the NAV was up slightly, 1.5%. They're still collecting 100% of their rent, which is going up. So net rental income up 7.7% over the same period last year. Low vacancy rates, very reasonable loan to value of 30%. Relatively cheap debt at 2.6%. There's no floating rate exposure there. And although some of it actually is due to come up for renewal next year, the average maturity of the debt is almost 5 years. So, the numbers all look really good, actually. The other thing that's happening is that the trust is selling some assets. And this is quite important because we've heard so many analysts, commentators, and investors all ask for alternative asset trusts to prove their NAVs by selling some assets. And it's interesting that Trixtax Big Box have been doing that, and they have been achieving asset values very much in line with their valuations. That's what happened with an £84 million asset they just sold in Northamptonshire. And they disposed of £235 million worth of assets so far this year, which more than covers their development capex and some selective acquisitions as well. So they're being very prudent, I think, with their debt, but they're self-funding their development. And that's quite important, that they do have actually quite a significant development pipeline here. So the 5% covered yield that you're currently getting has actually quite a lot of scope for upside from here. And the trust says, it has 44% of potential uplift in the rent deliverable from its current development pipeline and rental reversion. So that's quite significant, and I think augurs well for the future if everything can remain stable here. Now, the shares did rally a little bit on the results, and the discount narrowed to 23%, which is still actually fairly wide for a big trust of this quality, I think. But I did notice this morning the shares have given up some of yesterday's gains, so I think the discount's back out to 25%. And anyway, because this is, I think, one of the bellwether stocks of the sector, it's worth taking note of how it moves now in response to this good, decent, stable set of results. And I did notice in a research note from Winterflood, they said that 81% of the investment trust real estate sector market cap was, so in other words, it's weighted, was re-rated in July. So a much better month for UK real estate. You can see on the chart there, which goes, it's a 3-year chart, you can see how this discount opened out, but also how there was basically a big one-off hit to NAV in the second half of last year. And it's now looking steady again. So we'll see if that discount narrows further. We'll move on to the fallers. On the whole, these were not too substantial. It was a decent month. At the top of the list is HydrogenOne Capital Growth, which I'll talk about. And I do think there's a bit of a theme here as well, which is that new energy, really, I think, was a sector that was somewhat out of favor, still suffering some deratings. And I think there are probably 2 reasons for this. Well, maybe 3, actually. The list does pile up when you think about it. One is just the general negativity around interest rates and high yield companies. And if you're comparing them with bonds, the yield gap maybe needs to be a bit bigger, which is why these have been derated. The second thing is the UK power price curve not looking terribly attractive for the ones that are sensitive to power prices. And we've seen some deteriorating conditions in, for example, the battery storage sector in the UK, where the returns are coming down a bit. I still think the reaction here from the battery storage trusts is overdone, but nevertheless, there is some reason behind it. And I think as well, there's just been some slight issue for the sector as a whole, because there are obviously individual trusts with issues. And obviously James was just discussing the ThomasLloyd one there. And that tends to drag everything down a little bit, as all of these perhaps secondary trusts, these aren't really the mainstream ones that are going down. These secondary trusts are undergoing a bit more scrutiny. And there are trusts with issues here, including Digital9, which I'll talk about. So Digital9 has certainly had its problems. I mean, I think it's a very interesting underlying sector, actually, this digital infrastructure. But effectively, Digital9 is working through its issues now. It did have a very important update during the month where it said that it was going to sustain its 6p dividend, which was under threat. But it has said it will carry on paying that, and that it expects it to be covered by operating cash flow by the end of 2024. And that's quite important, because if you're buying the shares now at, I think, 57.5p, you're getting more than a 10% yield. So if you believe that actually their issues will be sorted out, and you're prepared to be reasonably patient, you can just sit on your 10% yield and wait. The important bit of news that's coming up here is that the company is syndicating interest in its Verne Global group of companies, and is expecting news on that in the third quarter. And I think if the syndication looks pretty good, then that could certainly give these shares a boost. And in the meantime, there is a mammoth discount of 48%, which the board is extremely aware of, believes it's completely unjustified, as all boards do. But I think in this case, they have a reasonable case to make, and the investment manager and the directors have all been buying the shares, which may give you some comfort. I think this is a bit of a speculative situation, but worth having a look at, because the discount is enormous. And I think one of the questions that everybody likes to ask is, whether there's a catalyst for a change. And I think in this case, the syndication news could provide that catalyst. So again, one to watch. And then finally, HydrogenOne Capital Growth, which was the worst faller on my list there. It's actually had two very bad months where the shares have come down very considerably. This is such an odd trust, because I think it must be highly illiquid. These shares have been extremely volatile since launch. I remember right from the off, the shares accelerated away up to about £1.20, and then almost immediately fell back again. And they've been pretty volatile since. You can see from the chart here that recently, they did have a big rally, and they've come all the way back again. I don't think there's any particular reason for that. It's just, I think it doesn't take very much to move these shares quite a long way. It'll be really interesting, I think, to have a look at the second quarter results, which are due out on Monday. The first quarter results were pretty good. NAV was up slightly to 100p. So we'll see what happens on Monday. My sense is that if the trust actually does have a decent quarterly set of results, and I don't really see why it shouldn't, then that may reassure some investors, and we might see a little bit of fresh buying. We'll see. I can't preempt what's going to happen on Monday. But while you wait for Monday's results, if you have any time over this weekend, I think it might be worth just having a look at a new guide that the trust has put on its website, which you can download, the Bluffer's Guide to Hydrogen, which is actually a really useful and interesting guide, which runs through the different types of hydrogen. So if you've always been perplexed about green and blue and grey hydrogen, it'll explain the difference. It explains why hydrogen is good to use, the various uses that are available, and also runs through the portfolio holdings. So this trust is quite concentrated. It has 10 portfolio holdings, all of which are private companies. But one interesting thing that I just picked out actually from the guide is just a couple of sentences here about how quickly the sector is developing. And I think hydrogen is somewhat shoved to the side because, we're talking about solar and wind all of the time. And it's quite interesting. And it is developing quickly. You can see, from the quote here that the number of companies that the trust is tracking has increased quite a bit, actually, in a very short period of time. And I think as long as the investment universe continues to grow, that this trust will have more choice. That's a good thing. Of course, one difficulty for it is that it's not going to be raising any fresh share capital anytime soon on a 50% discount. So, I don't know quite how it's going to access all of these new opportunities. It's fairly unlikely it's going to recycle its capital very quickly, I suppose. So that's an ongoing issue, which I'm not sure what the solution is there. Nevertheless, I commend the guide to you, and I'll be looking out for that one on Monday. Good, that's it from me, James. I will hand back to you now.
Thanks, Andrew. Actually, what we'll do is I think we'll share that Bluffers Guide on our website, so you can come and read it there. And we've got David Johnson is going to go to the meeting on Monday, so he'll write that up on Monday. So you'll get the information on that too. Thank you very much, Andrew. Now then, just make sure. There we go.